You might have heard the news about the Fed raising interest rates, but what exactly does that mean? How does that impact the economy? And more importantly, how does that impact you? Hi, I'm Terry, financial coach here at Dow Jones, and today I'm going to break down everything you need to know about the rising interest rates so that you can make the most sound financial decisions in this current economic climate. So get ready to take notes because we're going to cover a lot of ground. But first, if you want more tips for mastering your money, make sure you subscribe and hit that notification bell. We put out new weekly videos every Monday to help you on your financial wellness journey. And if you want to learn how to take your investing to the next level, make sure you sign up for our free investing masterclass. I'll leave a link for it in the description. What is the federal funds rate? Basically, banks that accept deposits from people like you and me are required to keep certain amounts of cash on hand available in case people want to make withdrawals from their money as well. This amount of money is determined by the total amount of money that gets deposited at that bank. Okay, so the amount of money in each given bank fluctuates. It goes up and down based on how many people are going in and making deposits or taking out withdrawals. So if a bank thinks that they are going to be over the amount of money that they need to keep in their bank, they can actually loan it to another bank who feels like they may not have enough money on hand. The interest rate that these banks charge each other is called the effective federal funds rate. So why is the Fed raising interest rates? Okay, so there's a group of people from the Fed. They are called the Federal Open Market Committee. I'm just going to call them the committee from here on out. And they meet 8 times a year or more if the economy is really a mess in order to decide what the federal funds rate should be. To make things a little more complicated, the Fed, or the Federal Reserve, they're not actually the ones that set that federal funds rate. That's actually determined by the banks. But the committee does set a range of rates where it should be the target federal funds rate. So let's say they set the target federal funds rate, the upper limit, at 2.5%. This means that a bank cannot charge more than that for their effective federal funds rate. However, in order to get into that target range, the committee can actually either add money into the economic system, which increases supply, and then that lowers the effective rate, or they can take money out of the system, which then decreases the supply and increases the effective rate. I know I just threw a whole lot of information at you, so if you are still with me, please give this video a thumbs up. If you need to go back and review, feel free to do that also. All right, moving on. The Fed sets the target federal funds rate based on the health of the economy. So, for example, let's take a look at what the past few years have been like. First, there was the pandemic, and when the pandemic was at its worst, the rate was at 0% as a lot of businesses and families were struggling financially. But since then, inflation has spiked, and in fact, it's at its highest point that it has been in the last 40 years. So we have a full video on inflation, and I'll link to that in the description. But put simply, inflation is a decrease in the spending power of money. So for instance, something that cost $5 a year ago might now cost $8, meaning that your $5 bill can buy less than what it could buy a year ago. Moderate inflation is generally considered a normal sign of a healthy economy. However, when it comes to inflation becoming too high and too rapid, it can erode the purchasing power of consumers and completely disrupt the economic stability. So, to offset this, the Fed has increased rates to record highs. Basically, what the Fed is aiming to do is increase rates in order to force a slowdown of economic activity. Remember, economics is really the concept of supply and demand. So when demand is really high, like a lot of people want to buy a house, and supply is low, not a lot of people are selling their houses, then the prices go up, and the reverse is true as well. When the demand is low and the supply is high, the prices go down, right? There's a lot of people trying to sell their homes, and maybe not a lot of people want to buy a home because of interest rates, so the prices start to fall. So the Fed is really hoping for a domino effect. Because they've raised interest rates, borrowing starts to slow down, spending starts to slow down, and then in turn, businesses produce less because people aren't buying as much. So now they're not producing as many goods and services, which can alleviate the skyrocketing prices that happened because of the excessive demand earlier. The Fed typically raises interest rates in really small incremental steps, quite gradually, in order to avoid causing really big economic disruptions. They carefully monitor different economic indicators and then adjust their monetary policy accordingly. That's what we've seen. Most of these interest rate increases over the past year or so have been in 0.25% increases. So it really can take time for the Fed to see the impacts of that increase, where it starts to have the desired effect, where the economy really does start to slow down. It could take several months, but it might even take several years for the Fed's actions to fully affect inflation. So in the meantime, you still might be asking yourself, how does this impact me? As I said, the overarching goal for the Fed is to bring down inflation. But in the meantime, here's a couple of key things that you want to be aware of as you make financial decisions. So first, you could pay more for debt. So while interest rates on savings are going up, unfortunately, the cost of borrowing money has really gone up. Now, if you are locked into a good rate, you're fine. No problem there. But if you're needing to borrow money right now, it might be a little bit discouraging in these times. So something to note is that if you do need to finance a car or a mortgage right now, it's not the end all be all because rates are high. Historically, rates do go back down, and so you'll likely have a very good opportunity to refinance in the future when those rates do come down. Now, unfortunately, if you do have a variable rate product like a credit card, your interest rates on that might be going up right now. So if you are interested in information on how to pay down credit card debt and fast, we definitely have a lot of videos on that too, and I will link those in the description below. Now also, you can be earning a lot on your savings right now. So the rate that the Fed sets is very closely tied to the same rate that we see for savings accounts at banks. So things like a certificate of deposit or a high yield savings account, those have really great interest rates right now. So it means it's a good time to put your money into those types of accounts. So do a little bit of research, find out where you can grow your money with the highest interest rates, and if you want some tips and recommendations for where and how to find some of these high yield savings accounts, be sure to check out some of the videos that we have that are linked in the description below, where we also talk about these different savings accounts. It could also be a really good time to get into the stock market. So to be clear, we are not trying to recommend that you time the stock market. However, right now, if stocks are going down, that kind of stinks for what you might be seeing in the investments that you already have, but think of it as stocks are on sale right now. So your purchasing power in the stock market can be better. So your money will buy more stock right now if their prices are also low. So that really can be a good opportunity to enter the stock market at a lower price. So if you want to learn how to overcome a lot of the roadblocks that stop many women from entering the stock market and how to implement our tried and true wealth building system, then check out our free masterclass. We will link to that also in the description. Okay, some final thoughts. At the end of the day, rising interest rates aren't inherently good or bad, but it is something that you need to be aware of in order to make smart, informed financial decisions. So I hope this helps you to better understand our current economic climate and as you decide the best ways to manage your money. Like I said before, if you want to learn more about wealth building, I will leave a link to the description below for our free investing masterclass. I hope to see you there. Take care.